historically, when the CAPE is in the mid-30s, the return over the ensuing decade is close to zero. So if you think about it, if the stock market was at whatever it was at in late 2019, let's say January 1st of 2020, then what should you expect it to be on January 1st of 2030? Well, if the CAPE is in the mid-30s, you should expect the return to be close to zero. So wherever the stock market was on January 2020 is about where you should expect the stock market to be in 2030.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with John De Goey. He's a portfolio manager, a podcaster, and an author who has a passion for helping people understand behavioral biases in their role in finances. So, John, as I said, what I love to do is kind of let you tell your story. But first, thank you for coming on the show today. Thank you for taking the time out. I know it's a day off for you, a holiday for you. So I appreciate you spending the time here with me to share your story. Thank you very much.
Thank you, Jason. It's my pleasure.
Awesome. Well, let's start with your background, your story, what kind of got you to where you are today, and we'll dive in from there.
How much time do I have? I started off, I did a graduate degree in public administration, so I wanted to be a government employee. So a master's in public administration is like a master's in business administration, only for the federal government. Okay. The program at Carleton University in Ottawa, Canada, is co-op, and so I spent some time on Parliament Hill. And one of the things I was doing in one of my co-op terms was looking into interest rates on credit cards and just helping government officials get a handle on what was going on. And I realized in my first work term, you learn about yourself, that I was a consumer advocate, that I wanted to do what was right for the general public when it came to financial matters. I graduated, I moved to Toronto, and after a year or two of doing a few contracts, I started my work as a financial advisor in September of 1993. So we're now coming up on 32 years. I've been doing this for 32 years. And I realized that I wanted to help people, and that the industry, the financial services industry, is, I would say, as I went on my journey, I realized that the industry is what I will call amoral. It's not evil, but it also, like any commercial endeavor, it will tell you what it needs to tell you to fulfill its obligations from a disclosure and regulatory perspective, but oftentimes what's not said and what's implied but not actually true is oftentimes very good for business, very good for corporate profits. And so there were a lot of things that the industry was doing that were not really helping people. So I realized that I wanted to help to expose maybe the sort of underbelly of personal finance. And again, don't get me wrong, it's a great industry. I love it. I love what I do. I think it's very rewarding for me personally, emotionally, but I think there are also some elements to the industry that are maybe self-serving, might not be self-evident to people that are casual users of financial advice. So I began my career as an advisor. I started writing. I've actually written 3 books, the most recent of which is Bullshift, which is there over my shoulder. But I've written a couple of others as well. I've written articles for the press, and I've started a podcast. And I made the decision, I guess the last thing that I will say that I think might be material for you is that I've been in the business for 32 years now, but about halfway through, after the global financial crisis ended in 2009, I made the decision to become a portfolio manager. And what that means is that I can now exercise discretion on behalf of my clients. I don't have to call them to say we're selling, 100 shares of this at this price right now, and then we're going to use the proceeds to buy 50 shares of that at that price as soon as it settles. Don't have to do that now. I do the sell. I do the buy. I do the trades that are consistent with the client's profile. They just give me the money, and I am obligated as a fiduciary to do what is in their best interests. And again, given my concern about the industry not always doing what's in people's best interest, I took it upon myself. I maybe maybe I'll call myself a financial services vigilante, someone who took it upon himself to do what he felt was right, because I was frankly constrained in doing what I felt was right by the way the industry was set up until I took that last step to become a portfolio manager so I could exercise discretion.
Yeah, that's something I've I guess also personally experienced or noticed in the financial services industries. I mean, for me personally, it's been in real estate syndication, but when you're it's an interesting spot to be in because you you said you love the industry, you sort of recognize the value of it, and there is a tremendous amount of value in investing in general, and people maybe miss out on some of that. But then some of those investment vehicles maybe aren't always 100%, I don't know, client, investor, whatever, friendly. And so it has been maybe an eye opener for me as well. I love that you have 30 plus years of experience in this, because I found that makes a huge difference in people's approach to whatever the investment vehicle might be. Having gone through multiple market cycles, you mentioned the global financial crisis. I assume some of these things are different between Canada and the US and what I'm familiar with, but also at the same time, market cycles are market cycles. Like there's ways to navigate them. So maybe I'm wrong about that, but
I, I would say they're about 80 or 90% identical. There
okay.
will always be nuances on the margin, but the broad macro concerns, the global economy really is a worldwide global economy, and frequently whatever happens, especially on the same continent, will affect other countries on that continent as well. You can insulate yourself a little bit by moving, across the ocean or what have you, but certainly the Canadian economy and the U.S. economy are very closely linked, and I don't think the global financial crisis was materially better or worse for either country, with the possible exception of Canadian real estate didn't get hammered in '07 to '09 the way U.S. real estate did, but certainly the stock market felt it the same way, and the bond market and everything else. Yeah.
Yeah. Okay. Well, in I guess as I mentioned, regardless of exactly the nuances within those cycles, the down market, the bull market versus bear market. I mean, they're those are things that happen in investment cycles, and so someone who has that experience that you do in navigating them, and acts as a consumer advocate. I mean, I think that's a very powerful weapon for investors to have, to kind of have your base of knowledge in there. When I mean, you don't have to get super specific, but you're welcome to. I'd love to hear some of the things that you think are some of the reasons why you didn't feel like a consumer advocate in sort of the early career days, and then sort of went your own direction. What sort of problems that people are not aware of that maybe they should be aware of?
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Sure, I can give you a couple examples. I was in the first few years of my career, I was with a firm that was an aggregator that was vertically integrated. What that means is that they manufacture products and they also recommend products. And there's a higher profit margin in the products that they manufacture because there's more money in the manufacturing of investment products than there is in the distribution. So if you can be a manufacturer, if you can run mutual funds or exchange traded funds, you generally make more money than the company that employs the advisors that gives the advice on which ones to buy. So a lot of what firms were doing in the 90s, and this continues to this day as the industry consolidates, was that manufacturers were buying distributors because they needed to have shelf space, and everything became proprietary one way or the other. So in the 1990s, I was at a firm that was one of maybe the first major consolidator in Canada. And the idea was to get people that were in third-party products and get them moved over to proprietary products because the profit margin on those proprietary products was about 3 times as high. So the money we were making for giving the advice is identical because I know the fee that I charge is identical whether you use product A, B, or C. But if I use product A, the company product, the company makes 3 times as much money than it does if I use product B or C. That is the sort of thing that most consumers don't think of. There's a professor at Harvard named Sunita Saw, who Sunita did some research maybe 8 or 10 years ago showing that there's actually an agency issue that the industry would say, well, the way we solve this problem is through disclosure. And they'll say, and here we have a number of products that we could recommend to you, and we're recommending this product, which is the one that we happen to manufacture. And what Saw showed was that people actually think, oh, this guy's a really great guy. Look, he's so transparent. He's disclosing that he's selling us a proprietary product. But of course, what he's not disclosing is that the company makes 3 times as much money on this proprietary product as opposed to a third company supplier. And so what you have is this perverse situation where the regulators are trying to solve the problem through disclosure. And not only are they not solving the problem, but they're cementing in a preconceived by behavioral tick, which is people tend to trust people more if they make a disclosure, even if that disclosure is, I'm just disclosing to you that what I'm doing is actually not in your best interest. But people go, wow, but great disclosure, and they like it. So I was uncomfortable with that company's business model and ended up having to move on. Not that the products were bad, but the products were expensive, and the reason they were more profitable is because there was more profit that was baked into the price. And so those are the sorts of things that that was a very personal story that I have from the 1990s into the early 2000s. Another story that I would tell you now, Jason, is that this is very much the case in 2025 to this day. There are products, oftentimes exchange traded funds that are, or index funds that are very, very cheap, that do every bit as good a job as actively managed funds that cost more. And a lot of people don't understand that the 1% difference, which is typical, it could be 80 basis points, it could be 105 or 110, but it's typically about 1% difference in price, goes straight to the bottom line. So the finance industry is the one industry where the cheaper products are basically the better products. To use a phrase used by John Bogle from Vanguard, you get what you don't pay for. So if the stock market returns 8%, and you're using a product that costs 1/4 of 1%, then your expected return, all else being equal, is 7.75. And if you're in the same stock market, but you use a product that costs 1.25%, your expected return is 6.75% because you're getting the return of the benchmark minus the cost of the product that's used to get access to that benchmark.
Right.
And that is the sort of thing that I think when I say it to you on a podcast like this, you go, yeah, that seems intuitive. But the industry will always have you believe that the added cost adds value. Well, it categorically adds cost, but what it does is it disperses the outcomes. Another guy by the name of William F. Sharpe, who's emeritus at Stanford, he's retired, but he's not far from your neck of the woods. He won a Nobel Prize for something called the capital asset pricing model, and he wrote a paper in the Financial Analyst Journal literally 30 years ago, I think it was in 1993, called The Arithmetic of Active Management. And he just walked people through what I just explained to you in a moment, like the expected return of all active and passive managers before cost is the return of the benchmark because collectively they are the benchmark. And so if one costs 1%, well, if one collectively costs 1% more than the other, then that one product type will collectively on average return 1% less, precisely because it costs 1% more. So you get what you don't pay for. And in other lines of work, you get what you pay for. Usually, if you want to get a better tie or a better suit or a better TV or a better set of earbuds or whatever, the better products cost more. But in the world of finance, investment products, the best ones are usually the ones that cost the least because they pass the cost savings on to you and you get a higher return.
That is so much more eloquently explained than I have ever heard it or been able to articulate myself. But I've said a much more dumbed down version of that to friends of mine before. Like you're paying someone to manage something that you could also just pick up your Robinhood app and purchase that ETF.
Right.
You're gonna have the same performance. Like I think it's fairly well documented that nobody has outperformed stock picking or anything like that over kind of the life. I don't remember the exact.
I wouldn't
Warren
say
Buffett
nobody, but
experiment.
it's extremely rare. The evidence, Jason, I'm fairly familiar with this. Is it's extremely rare. It doesn't persist. So even if you outperform for the past 5 or 10 years, doesn't mean you're going to outperform for the next 5 or 10 years. And prospectuses disclaim that. It actively says that past performance may not be repeated and should not be relied upon. And it varies. So if the expected return of the benchmark the S&P 500 returns 8%, let's say, you're going to get 8% on average, no matter what you invest in, minus the cost of whatever it is you use to invest. The things that track the benchmark will get you almost exactly that benchmark minus the cost of tracking it because they're tracking it. They're not trying to beat it. They're not trying to lag. They're just trying to get you the same thing as closely as possible with as few drags and as possible. There's a huge variance. There's a huge dispersion of the people that try to beat the benchmark. There might be some people that get you 15 or 16%, but there will some that will get you negative numbers. So if you think of a bell curve, most get you around 8% minus the cost, but there will be a few that do very, very well. But the only way that you can do really, really well is by trading with a counterparty that's also trying to do well, that unfortunately is losing that trade, and that person is doing very, very poorly. You don't add money by trading. It's just that the more one person gains, the more the other person that he's trading with loses. But increatively, they make up the market. It's just the way it all works. So you can't get blood from a stone. You can't manufacture a higher than market return by trading in aggregate. You can always find the exception, but the exception is rare and not persistent and cannot be relied upon and cannot be identified in advance. And by the way, it also costs more in terms of taxes. So the people that trade more trigger more capital gains and give you a bigger tax bill when you do your taxes in the spring as well.
Yeah, that's a great point. Well, let's, I guess, argue the other side. You're, as a portfolio manager, what are the reasons where someone might come to you and bring your transparency and your view of how this all works is, to me, that's the reason. But what would you say to someone who's like, well, then why don't I just do this myself? What kind of...
I'm going to say something that is going to sort of blow your mind because it's probably not what you expect. So I just talked about price in terms of access to an asset class, but an asset class can be expensive. So think of buying a house or buying a car. You can buy a cheap house or an expensive house, a cheap car, an expensive car, and you might have to use a realtor to buy the house, and you might have to pay a sales rep a commission to buy the car or whatever. Mm-hmm. So a lot of what I was talking about originally in terms of the price is sort of the commission of using the intermediary. But it's not a wise decision to buy $1 million house for $1.2 million just because the realtor gave you a good deal on the commission. You saved 1% on the commission, but you paid an extra $200,000 to buy the house. So there's two ways of looking at cost. There's the cost of the transaction, and then there's the cost of the investment itself. So the point that I would make to you is that everything I just said in the past 5 minutes, while true, is true with regard to publicly traded stocks and bonds, things that are widely available. But those are asset classes that are currently extremely expensive. How expensive? Warren Buffett has this thing called the Buffett indicator, where he looks at the price of the U.S. stock market divided by the U.S. GDP. and it's at an all-time high. It's around 210. Fair is around 100. So basically, the stock market is more than double. Similarly, Robert Shiller, who is a Nobel Prize winner, he's originally from Detroit, but he's a professor at Yale. He won the Nobel in 2013, and he has this thing called CAPE, cyclically adjusted price earnings. And the cyclically adjusted price earnings ratio for the S&P 500 right now is at around 38. Historically, it's in the high teens. Again, another way of saying that the stock market, based on historical valuations, is twice as expensive as average, which is another way of saying they could drop by 50% and still be fairly priced. So it might be worth paying a slightly higher commission and buying products that are a little bit off the beaten path, private equity, private debt, or private real estate, things that are not as thoroughly actively traded. You might have to pay a little bit more to get access to the asset class, but those asset classes are not as expensive. So I would rather buy the $1 million house and pay a 5% commission to buy it than buy the same house for 1.2 million, but only have to pay a 4% commission to buy it. I would rather get something that is of actual value, even if the cost of the transaction to get access to that asset class is slightly higher. I want to buy the asset class at a fair price, not at an inflated price.
That's fantastic. That's a fantastic explanation. And it actually brings me to sort of the next question. So as a portfolio manager, along the lines of what you just explained, does that mean you are helping people within different asset classes, meaning not just stocks and bonds, which I think a lot of at least a lot of the financial advisors I know of that my friends use, their options are basically stocks, bonds, and insurance.
That's precisely right. So I have relatively little in traditional asset classes right now, even though I believe that those markets are efficient and you should buy them using cheaper options. I'm buying other asset classes that are less conventional, infrastructure, private equity, private debt, private real estate, a little bit of gold, some structured notes, things that are maybe a little bit off the beaten path, and they're going to cost a bit more. But I buy them because those asset classes are not nearly as expensive based on valuation. And again, because I have discretion, I can do that. I don't even have to speak to my clients about it. This is on me. I'm wearing this. My concern, candidly, as we record this in early August, is that stock markets around the world, but especially in the United States, are extremely expensive right now, and that there could be a reckoning, and it could be fairly painful. Not only because of the CAPE ratio that I mentioned earlier, but also because of things like accumulated debt. I don't know if you know this, Jason, but the debt level in the United States right now, the accumulated debt is over 37.1 trillion. That's a TR trillion dollars and growing by more than 2 trillion a year. That's not sustainable. And so there's a lot of pressure. We have, you have a president who's putting pressure on the Federal Reserve to lower rates. So the cost of carry is not as much, but we have inflationary pressure, and it's going to be very difficult for people who have to navigate the system in terms of public policy to find their way through, because we're in a bit of a bind. There's a risk of something called stagflation, where the economy is slowing down and inflation is simultaneously heating up. And usually it slows down and inflation slows, or the economy heats up and inflation heats up. It's usually both or neither. But when you've got both things going in the wrong direction, central bankers, people like Jay Powell, are in a tough situation, because now if you raise interest rates to keep inflation under control, you slow the economy even further. And if you lower interest rates because of the debt and because you want to keep the economy growing, you run the risk of inflation going out of control like it did in 2021. And so we're in a situation right now where the problem is challenging. The markets are priced to perfection, and if anything goes even remotely wrong, it'll be very difficult to fix it because of the situation that we've slowly over the years wheedled our way into.
Yeah, that's so well said. I wonder about this. I mean, I don't have anywhere near the level of knowledge that you do in this space, but I wonder, almost from maybe just a perspective of common sense. But I do two questions that pop up in my mind a lot. One is we often talk about historically X happened. And so then when things like that along that, happen that mimic history, we think, okay, it's going to happen because that's what happened before. Do you think there's anything to the argument maybe that we aren't the way history was structured before? We are now in a space where maybe technology, AI, things are different to a level that we can't think about it in reference to what historically happened. Like, is that anything that I never hear anyone talk about that, but it's in my mind. I'm like, well, maybe it's just not like history was like, and that's, so maybe we have to look at things a little bit differently. I don't know what the answer to that is, but I'd be curious what you think.
It's funny because my wife and I were talking about that just this morning. So it's actually a really good question insofar as I know people do think about it. And because I'm a person who believes that history is undefeated and that eventually valuations will come home to roost, even though those valuations, that CAPE ratio that I was telling you about, that CAPE ratio has been in the mid to high 30s since before COVID, since late 2019.
Sure.
So the market is expensive, but it's been expensive for 5 2/3 years. And usually, again, to put it in perspective, with Shiller's work, usually when the CAPE ratio is that high, it's a rotten predictor for market timing. And again, the fact that it's been that high for 5.5 or more years shows that you can't use CAPE to time when to increase or lower your exposure to an asset class. But it does give you it does have a ridiculously accurate read on what the return of that asset class will be 10 years out. So CAPE actually looks back 10 years. So there's a lag effect. And usually over the course of a decade, things will revert to the mean. And so historically, when the CAPE is in the mid 30s, the return over the ensuing decade is close to zero. So if you think about it, if the stock market was at whatever it was at in late 2019, let's say January 1st of 2020, then what should you expect it to be on January 1st of 2030? Well, if the CAPE is in the mid 30s, you should expect the return to be close to zero. So wherever the stock market was on January 2020 is about where you should expect the stock market to be in 2030. That should scare the bejesus out of you because the stock market has been rocketing up from 2020 until today. And if that's any kind of a predictor, then that's what you could expect. So that would be the argument that I would use, that I personally use, and that I believe most people who are students of history would say, well, things always revert to the mean in the long run. Sometimes the long run takes longer than you expect, but this idea of a new paradigm based on AI, based on valuations, this is exactly what happened, by the way, with the dot-com bubble in 2000, 2001. We had a Y2K problem in 1999 and 2000, 2001, and the market crashed. And it was the same sort of thing where people said there's a new paradigm, and companies were just coming out of nowhere and putting a .com after the company name, and suddenly the valuations were 10x what they otherwise would have been. And people were talking about, this is the new way of doing things, and things got extremely. By the way, that was the only time the CAPE ratio was even higher than it is today, was in 2000, 2001. And of course, it all came crashing down. And again, no one knows when it's going to happen. No one knows why it's going to happen. And the idea of this being a new paradigm is extremely seductive until the music stops. But then when the music stops and not everyone gets a chair, then everyone goes, oh, what's going on here? So I will concede that I cannot explain why the market has remained this frothy for this long. I just wrote a blog post for my clients and sent it off to another friend of mine who's got a website asking if I was a broken clock, because there's a story about even a broken clock is right twice a day. And I've been saying what I'm saying to you right now for literally years, and it hasn't happened yet. And I continue to double down. I don't know. I don't claim to be able to time markets. I don't know when this is going to happen. I'm just saying these things are extremely risky. They're extremely expensive, and I would not want to be left high and dry when things fell out. By the way, my book Bullshift talks about that. It talks about how the financial services industry shifts your attention to make you feel bullish. So it's not just a cute little word. It's a portmanteau. It's not. I'm trying to get people's attention as they walk past the bookstore, right, with the
Right.
putting the F in a word that otherwise what might mean something else. And that's sort of what I'm trying to do. Is I'm calling out the industry for saying things or at least implying things that are not necessarily so. But the industry makes money not only by being amoral and not telling you about how these products are higher margin, they also make money by selling you a story about, oh, take a long-term view and markets go up in the long run. And by selling the story of optimism, and I'm an optimist, so again, don't get me wrong, but there's a point where you want to be a realist as well, and you want to be measured, and you want to be thoughtful and contemplative of what you do and why you're doing it. But the industry makes its money by managing assets, and it manages assets by telling people that tomorrow is going to be better than today, and you better get your money in now because the long run, the market goes up. And so there's not as much emphasis, in my opinion, on risk management today as there should be, because I would say the markets are objectively risky because of all the reasons I've just told you. But the mindset, the zeitgeist, the spin, the narrative of the industry is overwhelmingly positive because it has to be, because that's the way you gather assets so you can make money. And again, that's not immoral, but it might be a bit amoral in that it's not as fulsome and robust and complete a story as you could be getting. Like, surely to goodness, there must be a time when you should be careful. It can't always be a great time to invest. There must be some time when you need to be careful. But you never hear about being careful until after things have already gone sour. No one's really trying to warn people. I don't want to be Chicken Little, but I also don't want to pretend that there's no risk here. There's a lot of risk. You do what you think is right, but is this a different paradigm? I'll go back to your original question. I don't think so, but every day is a new day. Who knows?
Yeah. Yeah. It's I guess both things can be true. It can be a different paradigm in the sense that information is transmitted faster. We have, a broader access to information as a whole, but it still means if your stock market is based on it should truly be based on the value of companies, and ultimately.
Right. So a good way of pointing this out then, Jason, sorry to, I wanted to sort of drive the point home that ultimately you're exactly right. There was a new paradigm. The internet did transform business. It did. And now it's table stakes. Like, you can't have a business without having an online presence. You have to do it. 25 years later, the transition is complete, and the future was foretold, and it was in fact transformative. It was a new paradigm. But it was not a paradigm that played out in terms of market valuations and pricings. It's sort of like now in 2025, markets are catching up to the prices that people were ascribing to these businesses in 2000. It's like it's taken 25 years for the market to actually be worth the promise of what was being promised in 2000. It's not like it didn't happen. It did, but it was priced to perfection in 2000, and it pretty much had to fall down on the way to come back up. And like a phoenix, it rose, and we are back there now. But it's not a straight line. And starting where you were at one point and ending where you are right now, it's not like it's a steady slope. There's a lot of zigs and zags along the way. And when it starts up that high, it almost always has to come down at some point, even if it does go higher in the very long term after.
Yeah. Well, and you said it earlier, on those trades, someone wins, someone loses. Basically, it's like that's how. And so you've got that opportunity over time to have growth. But you mentioned the stock prices being based on the promise of future earnings. It's a multiple, and the multiple is based on what you think it's going to be in the future. And so you'd almost, in order for the stock market to keep growing, you'd have to assume that the companies are going to grow at the same rate that they are now for eternity to make those valuations worth it. Is that
maybe not for eternity, but for the foreseeable future, which
Right.
for purposes of our definition is a few years out anyway, maybe
Right.
many years out.
Yeah. Yeah.
Yeah,
And I guess that's, you're buying a price per earnings
yeah,
stock amount. And so that if that is, 30x, well, you got to assume that they're going to grow at a rate that fulfills that 30x
right.
valuation over years. And that happening is probably pretty unlikely, which kind of takes me to where I want to go next, John, is that it sounds like for you with your portfolio management, you're really talking, you have a diversification strategy in that you're not just stock market, you said private debt, private equity, private real estate, those sort of things. And I think that is probably the thing that's the biggest miss, is that people go in one spot, and most people are going in one spot, being the public markets, and they're missing out on the ability to diversify out of that, what we just talked about, to be able to have things to offset, hey, these stock prices are maybe too high.
So I agree, and I can give you a tangible example. So if you think of what foundations, endowments, pension plans are doing with their money, because they have a time horizon which is technically indefinite, because as long as the business is a going concern, they will have employees that will have pensions. Those institutions oftentimes invest with over half their money in the things that I was talking about. They'll only have 35 or 40% in publicly traded stocks and bonds. The rest will be in infrastructure, private equity, private debt, that sort of thing, because those are things that tend to have higher returns, but also because they tend to be oftentimes less volatile, but not necessarily, and because they are negatively or weakly correlated to publicly traded markets. So what that means is that if you find things that zig when other things zag, by holding a little bit of both, yes, one will always be down, but the other will always be up. And combine the glide path of your portfolio in any given month or quarter, or however long it is between when you get a statement or check your numbers, will even out, and it will be relatively stable. So if you think of, there's a guy named David Swenson over at Yale who wrote a book about this maybe over 20 years ago. And the Yale endowment, the Harvard endowment, all the major pension plans, if you start thinking about the pension plans in the U.S. and whatnot, they will all, don't take my word for it because I'm a Canadian, go check it out and look under the hood and see what they're actually invested in. And you will see a massive, larger allocation toward private investments relative to public markets, which is what you will see on virtually any retail investor's portfolio. If you look at your IRA or 401k, whatever, your company account. If you look at the company plan, oftentimes people don't get a statement to see what's in their company pension plan account. It's oftentimes a defined benefit plan, and there aren't many of those left anymore. But a defined benefit plan, just the employer is guaranteeing you a certain amount of money for an indefinite period as long as you live, and they will do that. One of the reasons why this is so. So you will ask, I think the obvious question is, well, why wouldn't more people invest more money in these things if they generally have superior risk-adjusted returns? Why wouldn't they do that? And the answer is largely that the underlying investments are less liquid. So a stock or a bond can be sold in 24 hours. Mm-hmm. But if you're owning, I'll use an extreme example. If you own an apartment building, or even if you just own your private home, you can sell it, and hopefully you can sell it at a reasonably fair price, but you cannot sell it in 24 hours. There is less liquidity, and so there's what's called a liquidity premium. The fact that the underlying investments take months, weeks, sometimes months, sometimes quarters to sell, means that it might take you weeks or months or quarters before you can get your money out. And investors, for whatever reason, like to be able to get their money out tomorrow if they need it tomorrow.
Yeah.
If they're planning properly, they shouldn't need it tomorrow. They should know that they're going to be buying the car at the end of the year, and it's now August, so let's maybe sell that thing that takes 3 months to settle now, so we have the money in November, December, so we can buy that car or whatever. Most of the time, that should not be a problem to plan. If you have a retirement plan where you get paid annually, okay, well, again, December's coming up. You know you've got to make your withdrawal. If there are things that take a few months to sell them in the late summer, early autumn, and you'll have the money before the end of the year, and you can take your annual amount without having to scramble or only sell those things that are sellable within 24 hours. So that liquidity premium is a great thing. And the irony of it all is that the financial services industry tells people to take a long-term view. So if you're telling people to take a long-term view, why is it such a great thing to be able to get out of whatever it is you're in 24 hours? Why can't you be a little more patient in getting out? And I haven't ever gotten a straight answer from anyone about that. The regulators seem to think that, oh, we have to protect the public. And this is actually where it's funny because I'm the consumer advocate. You know, we started off by being the consumer advocate. So I'm actually advocating for consumers getting more access to these higher risk adjusted return products. But ironically, my friends, regulators, will say, well, no, that consumers want to be able to get out of the money and get out of whatever they're in 24 hours. So they're fighting me as if I'm the guy that's not on the consumer side because I'm a proponent of higher risk adjusted returns that are weakly and negatively correlated to other asset classes. But because these things are not readily convertible to cash, suddenly I'm the bad guy. And it's very frustrating.
Yes, I agree. It's funny because I mean we do real estate syndication, and so we talk to investors a lot, and that liquidity thing comes up all the time. Like that's like, oh, I don't know, a 5-year time horizon is too long to think about. But all those people have 401ks and IRAs invested in what are supposed to be liquid assets, but they can't touch them for 30 years. And I'm like, none of it. Like if you actually break it down, none of it makes sense outside of there's some giant marketing machine and something in human psychology that's like, yes, we should do this thing because that's what we're told to do. But it really doesn't actually, because you mentioned it before, and I was going to say like the reason to have some portion of your portfolio in the public markets is that liquidity. Like that's the real reason, is so you have a portion of your invested capital that's fairly quickly accessed. But like really what you want are those long-term, more liquid assets that are going to have better returns and all of that. And it's a funny thing. You talked about the, separating from the public markets. And I think one of the things I think is a perfect example is like the high yield savings accounts. It's like high yield savings accounts are good right now because interest rates are high, that everybody's mad about interest rates being high on their real estate. And the real estate market has sort of come to a halt because of interest rates. But then the people are happy with a high yield savings account. But as soon as interest rates come down, that high yield savings account will go from 4.5 to 1. And it did. I've done it. I don't really remember much about the dot-com bubble, but I do remember the global financial crisis quite, like the impact of what happened around the before and after, really what happened there.
To give you an example, in my own practice, I have maybe 50 or 60% of my clients' assets in things that can be sold in a day, and another 30 or 40% of my clients' assets that can be sold within 2 months, and 10% in something that can't be sold for another couple of years. So there's a continuum, but most people, if they need money, they need a fraction of what they need. And most people, if they need a fraction of what they need and are planning properly, there's 90% of what you have invested that you can get out within a reasonable time frame if you know that the expense is coming. And if there's something that's really critical that comes out of nowhere, okay, I've got 50 or 60% of your stuff that we can sell for this true, genuine emergency, which happens maybe to one client per year. Almost everyone else, as long as you're thinking ahead and communicating with your advisor, the coming up with the money to pay for whatever it is that you need to pay for should never be a material problem.
Yeah, Completely agree. As you said, usually those things that are coming up, if it's a large purchase you know about, you're planning for it. If it's a surprise, it's not. Hopefully, it's not all of your invested funds, and so it's like in a lot of ways, oh, I have this thing coming up in 6 months. You probably like, if you have money to be investing, you're probably going to make enough money in that time to to cover most of that expense. So I think it's really very much a mindset shift in how you look at it all. But John, let me switch gears here. I want to ask you the questions I ask every guest, and the first one is just it's based on the name of the show being Know Your Why. So what is your why? I've gotten a lot of obviously you're passionate about this and about being that consumer advocate. But I'd love to hear a little bit more about, kind of what drives you, at this point. You've got a ton of really great knowledge and experience in the markets. I'm fascinated by this conversation.
I would say that I try to be a rational problem solver, and my why is helping people make better wealth decisions, which is the name of my podcast. And a lot of that means being thoughtful, being purposeful. Don't just do things because that's what your neighbor is doing. Don't just do things because that's the way they've been done in the past, because that's status quo bias. You stop, look at the situation, examine it for what it is. Don't sugarcoat it, and then make a firm decision based on the circumstances such as they are, and how the global macro economy is dovetailing with your personal circumstances. Is your job secure? What about your spouses when you have kids? And you have to do some personal customization. But the general rule, my why is that there's not enough customization with regard to how we make decisions with our portfolio in 2025 in light of what we already know. There's a lot of things that people know that they don't want, for whatever reason, hasn't made its way into the public's lexicon and decision making. And as a result, people tend to do things the way they always have. And that's not necessarily bad, but it can be. And sometimes tried and true is fine. But I don't want to be a proponent of tried and true just because it's always fine. There will, if there's a time when something better comes along, you shouldn't resist it. You should always be curious and evidence based and looking for the best way to do things. And my journey has been one of examining the evidence and coming to my own conclusions. And it's funny because sometimes people that are allies become less than allies, and sometimes people that become enemies. Hey, we're on the same side on this, huh? What do you know? Because the grounds are shifting, right? Because it's not as people come to accept information as it becomes more publicly available. People's attitudes toward certain viewpoints will also change. And so my why is to be in the middle of that discussion, to try to be an honest broker, to try to be fair, to try to park my own biases, and to try to do what's right for the client, irrespective of what I may have thought or believed or said or done in the past.
Yeah, fantastic. When people hear this and they want to connect, what's the best way for them to reach out to you?
My email address is jdeguy at designedsecurities.ca. That's a .ca. So JDEGOEY, designedsecurities.ca. I'm on LinkedIn. And my book Bullshift is available everywhere. And my podcast, as well as my YouTube page, is called Make Better Wealth Decisions. And I do a lot of what you do, Jason. I have a podcast every week. I speak to interesting people, and I get their viewpoints about personal finance and decision making. And it's the sort of thing that is part of my why as well.
Yeah, and we'll make sure we have all of those links in the show notes. I do want to ask, this is just my own personal, do you work with clients in the United States or only Canada?
I don't currently, but I could. If I wanted to, I could, but I currently do not.
Okay. I mean, your philosophy on all this is this is how I think people, like financial advisors, that you're the type of person I think people should work with. Someone who's got a full picture of multiple different asset classes. You're not, sort of selling products. I just think this is the way. So I think most of our listeners are from the U.S., but I just wanted to even know if that was an option for them. But yeah, I think this is exactly how I think financial advising, portfolio management should be structured. So thank you so much for being on the show, John. This has been great. It's been a really fascinating conversation for me. I've learned a lot, and I think listeners are gonna get a ton out of it. So thank you so much for being here.
Thank you, Jason. It was a pleasure for me too.
Folks listening, make sure you connect with John, and please like, rate, and review the show so we can continue to get more great guests. And as always, thank you very much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?